Holy shit, do we have a lot to get into here today, guys. It's been mostly chill and mostly bullish in the markets. Same thing with AMC stock. AMC is now positive, but what we are seeing as far as a 1% rate hike, well, it is now expected. Yes, a 1% rate hike went from yesterday, a 10% probability, now to over a 75% probability. Fed Bostic also said that everything is on the table when he was asked about a 1% rate hike just a couple of minutes ago, and we did get the Fed Beige Book that did come out that we need to talk about, and it is specifically this right here, the overall economic activity. This is going over all of the different districts of branches of the Federal Reserve. So this is what has caused this market drop. I want you guys to be fully aware of the current situation so you can make the most accurate decision with your money. It looks like we're getting a false rally here, guys, and that's just the best way to put it. So we're going to dive into all of this information. We're going to talk about AMC. AMC is up about 0.5%, just above that critical level at $15.65 per share, so it's looking pretty good, but there are some things we got to talk about, things to acknowledge here in this video. So hit that like button and subscribe to the channel if you guys have not already. Thank you guys for doing that, and let's get straight into it. So if you guys are unaware of what is happening today, because boy, it is a big day, well, inflation rose 9.1% in June, even more than expected as consumer pressures intensified. Cost surged for gasoline, groceries, rent, and dental care. Even core CPI, that is excluding food and energy, rose 5.9% compared with the 5.7% estimate. Now, what this is doing, well, it's doing a lot of things. We are now pricing in a 1% rate hike coming by July 27th. Markets have not reacted to that. The bond market has not reacted to that. Whereas the yield curve inversion, the difference between the 10-year and 2-year rates, reached biggest point since 2000. And we are now inverted 0.23 basis points, almost a full rate hike, with the 2 and 10-year spread. So what is this saying? Well, we're going into a recession. If not, we're already in a recession, right? There you have that. But you have 9.1% inflation. You now have the markets pricing in with a 67.2% probability of getting a 1% rate hike. That would put the federal funds rate in between 2.50 to 2.75%. That means 10-year treasuries, really all treasuries, have to come up in a big way. Look at the bond yields for the day. It's not playing along. There's a big push and pull, tug of war between what's happening with inflation, how much the Fed is going to have to raise rates, and when we go into a recession. So the markets are kind of trying to call the Fed's bluff here, because if the federal funds rate goes to 2.5 to 2.75%, 10-year treasuries cannot stay at 2.91%. But the markets are trying to say, hey, you know, we have a higher than not probability of going into recession. You guys are not going to be able to raise rates that aggressively. But if the markets realize the Fed's going to do it either way, you're going to see a big uptick in the bond yields, or something is just going to break in the markets. Now, I do think a lot of this potential downside will come off of earnings later in this month, and I obviously cannot forecast how earnings are going to go, but I do think they're going to be pretty negative overall. Now, we did just have Fed Bostic that came out and said everything is in play when asked about the possibility of a 100 basis point July rate hike. So I do think this CPI report, as well as Fed Bostic's comments, are really going to solidify the probability of this 1% rate hike, now at 81.5% chance. If we get a 1% rate hike, the markets are not fully pricing that in right now. The swaps, the futures for the federal funds rate is pricing it in, but the stock market is not pricing it in. So you got to be prepared for some major downside in a very short amount of time at the current moment. You are really in a danger zone. If you don't have protection on your portfolios, maybe it's not a bad time to do so. Obviously, not a financial recommendation. You could always lose money trading options or shorting stock, but we're not in a good situation right now. So just make sure maybe you don't have too much margin heading into the next couple of weeks. Now, what do we have as far as tomorrow? As far as economic data, we have PPI month over month for June. Okay, that's producer price inflation. So that'll be important. And then you also have retail sales month over month for June coming on Friday. And that is expected to come in at 0.5% positive. If we come in positive at all, really, in my personal opinion, or even better than expected, well, that's going to show the economy can withstand rate hikes and potentially not go into recession as quick, forcing the bond yields to react, forcing the Fed's hand to raise rates much steeper than what the markets are expecting. So we are really seeing a very docile day here in the markets, considering everything wrong that is happening under the surface. So you guys gotta watch out for this big downside. It's coming. It's the question of what day is it going to be where you get a massive downside move. It quite possibly could be tomorrow. Now, this is what has really derailed the kind of bullish activity we were seeing not too long ago throughout this part of the day, right? That's what gave us the 0.34% red candle and then some subsequent bigger red candles as well after that. It is the Fed Beige Book. Well, essentially what this is the summary of, what's going on in different districts, right? Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, San Francisco, right? So we're going to go ahead and read this. Overall economic activity. I think this is what moved the markets and gave us that sharp candle to the downside. So it says, economic activity expanded at a modest pace on balance since mid-May. However, several districts reported growing signs of a slowdown in demand, and contacts in 5 districts noted concerns over an increased risk of a recession. Most districts reported that consumer spending moderated as higher food and gas prices diminished households' discretionary income. Due to continued low inventory levels, new auto sales remain sluggish among most districts. Hospitality and tourism contacts cited healthy leisure travel activity, with some noting an uptick in business and group travel. Manufacturing activity was mixed, and many districts reported that supply chain disruptions and labor shortages continue to hamper production. Non-financial services firms experienced stable to slightly higher demand, and some firms reported that revenues exceeded expectations. Housing demand weakened noticeably as growing concerns about affordability contributed to seasonal declines in sales, resulting in a slight increase in inventory and more moderate price appreciation. Commercial real estate conditions slowed. Loan demand was mixed across most districts. Some financial institutions reported increased consumer usage of revolving credit lines, while others reported weakening residential loan demand amid higher mortgage interest rates. Demand for transportation services was mixed, and reports on agriculture conditions across reporting districts varied. While demand for energy products was robust and oil and gas drilling activity picked up, production remained constrained by labor availability and supply chain bottlenecks for critical components. Similar to the previous report, the outlook for future economic growth was mostly negative among reporting districts, with contacts noting expectations for future weakening of demand over the next 6 to 12 months. That is really the summary of what you can point out right here. The outlook for future economic growth was slightly negative among reporting districts, with contacts noting expectations for further weakening of demand over the next 6 to 12 months. So what you have essentially going on right now is this, like I said, a big push and a pull. But what is happening in the stock market is very different from the data that we are getting. The markets are not expecting this actual 1% rate hike. So I think from now on, it could be more important, at least until we get the next Fed rate hike, which will be July 27th, to see what happens with these Fed speakers. Now, the next Fed speaker is going to be tomorrow at 11 a.m. and that is Fed Waller. Fed Waller, he's going to be asked about a 1% rate hike, since the markets are now expecting a 1% rate hike. And if they confirm and they say they are fine with doing a 1% rate hike, the markets might have to take it more seriously, and that is going to be a very big deal. At the same time, the inverted yield curve is going to start drawing a lot more attention. This thing has inverted 14 basis points as of today, 167 4%. But the S&P 500 somehow is managing to go positive. This is actually one of the wildest divergence that I have ever seen in the stock market, where you have so much bad news, like solid bad news, and the stock market should not be going up, but it's actually going up. Divergent. Bad news is now like good news for the stock market, but this is like bad news. This is, you're talking the federal funds rate going up by 1% in 2 weeks. Kind of wild. But nonetheless, let's talk about AMC stock and what is actually happening today. Well, AMC up 0.69%. We are above our 100-day moving average at $15.65 per share. So if we can close out the rest of today above this 100-day moving average, you could see a very violent move to the upside coming tomorrow or on Friday. That's the way that I look at it. It's very substantial that you are seeing AMC above the 100-day moving average on this, quite frankly, wild move to the upside. It's been pretty much straight up over the last 5 trading days. We have been bullish. So I think that is very positive. We're going to talk a little bit more about that. As you guys can see, the MACD is bullish, but not as bullish as we could be. Obviously, we could be more bullish. You could see a wider divergence. That does lead me to believe we will see some more bullish activity coming in the near-term future. RSI is 63.32, so at healthy levels, not on the overbought side, but definitely starting to get a little bit close to those levels. And now, as far as the Ortex data, let's go to the short interest. We are looking at a cost borrow rate of 10.18% minimum, cost borrow average 11.75%, cost borrow max at 14.65%. You are seeing an estimated short interest of free flow at 18.4%. Free flow out on loan 26.55, 5%. Shares out on loan 136.87 million. Days cover at 3.34, 100% share utilization. The option activity is 19% positive, 18 orders totaling $4.24 million. This is a lot more of a dollar amount than what we usually see, and it's been a lot more bearish today than what we usually see. But AMC stock's still up over 0.5%. I think that is a very good sign given all the bearish option activity that we have seen today. Now, as you guys already do know, if we do continue to see a bullish rally, well, there's a lot of dry powder that will cause a lot of buying pressure for AMC stock if AMC can make a move to the upside. About 80,000 calls that are currently in the money, 508,000 calls that are out of the money, 65,000 puts that are also still in the money. So if we can get close to, if not break out above $20 per share, that's where you're going to see instantly about 8 million shares that has to be bought by the market maker. So pretty encouraging. As long as we can get that break above the 100-day moving average, which it looks like we should, that's going to be very encouraging. But still be careful here, because it's really a coin flip. If we do see a big down day in the markets, is AMC going to be adversely affected by that? Will AMC drop? Will AMC rally during those times? Only literally time will tell. But I do think all indications for at least AMC is very, very good and very bullish. So that is going to be all for this video. There was a lot to go over. Make sure to go back and re-listen to the video if you did not catch something, because it's a crazy one. And don't be fooled out there just because the stock market is starting to rally a little bit. We are nowhere near free and clear with this whole situation. So thank you guys for watching. Hit that like button and subscribe to the channel. Like I said, if you guys want to come trade with me live in real time, link down below in the description of this video. Thank you for watching, and I'll see you in the next one.